you're watching the workshop on overview of capital market. This is the third day and final day of this workshop, that is overview of capital market. Already we have attended the 2 days prior what exactly the capital market is. Dr. Aditya Srinivasan sir has explained very well about the gist of the capital market. I would like to thank our Dr. J.C. Purswani, our chairman of our college, S.S.T. College of Arts and Commerce, who always encourage us to conduct such a type of webinars, such a type of workshops in our college to give the abundance knowledge to our students about the current affairs, what is happening in the market, because it is must for the students to know what exactly the capital market goes on and how to do the trading in that capital market. Apart from that, in our institute, we have IQAC coordinator, Dr. Khushbu Purswani, who is always encouraging us to have such a type of, not only we should give the bookish knowledge to the students, but also what currently happen in the market, what currently the scenario, the trends are. That is what we always take initiatives to organize such a type of webinars. And we have with us the convener of Student Council Cell, that is Advocate Professor Sunil Shah sir, who always take the initiative to give the exposures to the students for visiting to the companies, for having the workshops in the college, and the students has visited recognized not only just companies but even the regulatory authorities such as RBI, then SEBI, and other even stock markets called BSE, NSE. So I would like to say, I would like to ask Sunil Shah sir to say a few words to our students. Over to you, sir.
Thank you, Varsha Savalani ma'am, the HOD of Accounting and Finance. As I said in my earlier 2 sessions of the workshop, the students are visiting to the regulatory bodies, the SEBI as well as the RBI, including we had visited to Bombay Stock Exchange. And Aditya sir, I am teaching securities law to the students of second year BBI. What is the Security Contract Regulation Act, what is SEBI, what are the disclosures to be made. In fact, in this 2-day session, first you had covered up insurance as well as investment, second you had covered up the Indian economy. Sir, when I met you during the in March 2020, you had rightly explained about the what would be the future of the stock market when we visited on 19th of Feb 2020, and that was that really came out into the limelight. So today's session would be much more beneficial to the students of who are watching as well as the faculty. Without wasting much more time, I'm handing over to Varsha Savalani ma'am.
Thank you, sir. We have with us the resource person who are with us from last 2 days. Okay, he is none other than Dr. Aditya Srinivas. He is working as a chief operating officer and a chief economist at Bombay Stock Exchange Brokers Forum. And I must say our students has also visited 2 days in that forum, and they have already learned the live trading on how to do the live trading on with the help of money control. Okay, sir has total experience, 16 years of corporate experience. He is representing India at Howard University, USA. Not only that, sir has represented in many different countries. I named a few, such as sir has visited and given the lectures in Japan, Maldives, Dubai, Hong Kong, South Korea, Taiwan, etc. Sir has already taken more than 2,000 sessions on the Indian economy, and as well as on the stock market. He has trained approximately 65,000 participants across India about the stock market. Sir is qualified in BBA Finance. He has done MBA in Finance and won the gold medal. Sir has completed PhD in Economics. Not only PhD, sir has completed DLET from USA. And sir has ISO lead auditor in 9000 ISO auditor. And sir has many national and international presentations, research papers, approximately 23 research papers sir has published it related to finance, related to stock market. So I welcome you, sir, on this final day of overview of capital market. Over to you, sir.
Ma'am, thank you for introduction, ma'am. Really thankful to S.S.T College of Arts and Commerce for organizing such an intellectual workshop, which helps not only the students but also the faculties as well as general public at large. Yesterday, I could see that more than 347 people had participated through YouTube, and I really congratulate for such a wide participation. I really appreciate the college, the efforts of the college. I would also like to thank all the faculties, especially Mr. Sunil Shah, who has been playing a vital role in bringing the students even to Bombay Stock Exchange. And as he aptly said, on 20th February 2020, I had taken the session, and it was really something where students had interacted with me and even I had appreciated them. Ma'am, just to highlight before I start the session, that before the pandemic, the total number of demat and trading accounts were only 5 crores 23 lakhs. And today, after the pandemic, it has reached 9 crores. So basically, this particularly change is the result of efforts of all the stakeholders, including all colleges who are supporting us in a big way in this investor awareness drive, ma'am. So I'm really thankful to the college, ma'am. Thank you for this opportunity. And today's session is also very interesting. So I'll now start the session, ma'am. It is asset allocation vital for wealth creation. So this will give a complete overview how one should invest and how one should take care of your financial planning and other things. Basic allocation means are the variety of assets like equity, mutual fund, gold, insurance, property, keeping in your own risk and return criteria. So that is why asset allocation plays a very, very critical and important. In asset allocation, two things are very vital. One is diversification, second is decent returns. These two things we have to keep in mind. Diversification means that basically if you talk of diversification, then it primarily refers to invest variety of asset classes so that the risk and return is proper, and at the same time the old age rule not to put all eggs in one basket is properly taken care of. So diversification plays a very critical and an important role. Then comes decent returns. Decent returns is basically that the whole objective of investment is to make good amount of capital, and that is why decent returns play a very critical and a vital role. So diversification and decent returns, these two things we have to keep it in mind. You should ideally have three objectives, and if these three objectives are being met, that means you have done your asset allocation properly. First is capital appreciation. See, capital appreciation means that whatever you have invested should get more than that. So that means your return on capital should be good enough. If you are getting say 12 to 15% return, then obviously you have your allocation of assets has been good and it really creates wealth for over a period of time. Second is safety of capital. Safety of capital again is very important because it means that at least whatever you have invested, it should not go waste. So that is typically called as safety of capital. And third vital aspect is basically liquidity. Friends, liquidity basically refers to that when you are investing your money, you should be able to get back your money at any point of time whenever you need it. So that is why this particular aspect of liquidity again is very, very critical and important. So if you are able to achieve all these three objectives, then definitely you have done your asset allocation in a much perfect manner, and at the same time you will be able to get good returns over a period of time. So these three objectives play a very critical and a vital role when it comes to your asset allocation part. This is something, friends, very important and critical. See, as far as factors of allocation is concerned, then it is really personalized in nature. Always remember, it is highly personalized. So three factors play a very critical role. Each of the person, income and job pattern, age based. The person is he's make more to take and will be able to achieve things easier because he's in his mind. Obviously, a person who is younger at age, his asset allocation will be totally different than from a person who is elder age. A person at a young age can always go aggressive asset allocation. That means he can basically equity, derivative, commodities, variety of assets classes in his portfolio. Whereas a middle-aged person or a person nearing the old age will obviously tend to have a straightforward kind of asset allocation, including FD and other things. Second, income plays a very vital role. See, income is direct in locations. Is on you can
Sorry, sir. Sorry to interrupt you, sir. Excuse me, sir.
Yes, yes.
Sir, your voice is breaking. Sir, sorry, sir. Sir, your voice is not clear.
Now it become clear, I think.
Yes, sir.
Okay. So basically, indirectly told you higher sum, the less one can limited. Finally, expenditure again is very important. If you have expense on your a big house loan, a car loan, or a capital goods loan, then sorry friends, there was some internet disconnection. Don't worry, I'll again join it. Yes. So to have a like a house, so then obviously a person is मैंने तो कुछ नहीं किया है, मेरा कनेक्शन भी सब ठीक है। तो मैं मोबाइल से ले लूं तो फिर ये पीपीटी सामने रखो, बट पीपीटी दिखेगा नहीं, चलेगा? हाँ, इसके लिए ठीक है, रुको ना, मैं ट्राई करता हूँ, ठीक है।
By the time sir will rejoin, I must say sir is taking a very good topic on asset allocation, okay, where the asset allocation plays an utmost important role while we are investing in different securities, be it equity securities or debt market, debentures or equities. By the time sir will rejoin, I must say sir is taking a very good topic on asset allocation. Capital market, as we all know, capital market is being regulated by SEBI, that is Securities Exchange Board of India, under the Act 1992. Okay, so as per that, we being an investors, we need to be very proactive while investing in different securities, and we need to invest in those securities which are listed, the companies which are listed, which are recognized by seeing the trend, past performance, how the stock moves. Okay, according to that, we need to invest. And sir is explaining us, sir has already explained in 2 days about the insurance, about the overall how the Indian economy works. And I must say, the entire Indian economy is playing a vital role in the entire world. Okay, the recognized, even that NSE, National Stock Exchange.
Now,
Yes. So can you please speak a sentence so that I can understand whether it's
now, ma'am, yes, ma'am. Now the voice is clear. Now is it
Yes.
coming clear?
Yes, yes, sir.
Fine, ma'am. I will just switch off my video so that bandwidth consumption is less. I will just switch off my video.
Okay.
Is it fine, or should I keep it on? Are you able to hear me well?
Again, your voice is fluctuating. You start
Can you hear me?
presenting. Yes, yes, a
Ma'am,
little bit. Yes, sir, you can present it.
okay, fine. See, fine. So can broadly include kind of markets and equity link does it, and also. Yes, then there's a problem for all portfolio. See, this is basically which basically is linked with your age bracket. One asset allocation is highly personal in nature, but even referring slide gives you a fair bit of idea. For example, a person is between 25 to 35 years age. In that case, he can, because young, energetic, he has more risk-taking ability. So he can allocate 75% of his investments into equity and equity-linked assets and 25% into fixed income. Fixed income means FD, Provident Fund, bond, debenture, company fixed deposits, which gives him fixed rate of interest. Then between the age of 40 to 50 years of age, he can invest 60% in equity and 40% in fixed income. See friends, when a person is between 40 to 50, obviously what will happen is that he would be married, he would be having children, there would be family, social responsibilities. Obviously, he will have fixed expenses on his head. So in that case, one needs to be careful about. So that again something an important aspect to be taken care of. Then if you see above the age of 50, he can invest 50% in equity and 50% in fixed income securities, because at that age, obviously he will have a lot of responsibilities, marriage, like children, obviously their future education, all those things will matter the most, and especially health issues. Friends, today, when you do investments, you have to keep certain amount of portion for insurance sector also, which we will be discussing in the future slides. And then friends, above the 60, when he's already in his retirement, he can have only 20% exposure in equity and basically 80% in fixed income. That is something we have to keep it in mind. Friends, this COVID time, if you see, actually, you will come to know that in this COVID scenario, it is important, friends, that one does variety of investments with lot of cautious, so that you are financially independent, and at the same time, over a period of time, you are able to create good amount of wealth for yourselves. So we will try to understand 8 different asset classes in which one can invest. 1 minute. ठीक है, रुको तो फिर मैं मोबाइल से ही लेता हूँ. Yes, friends, so cash is the first and the foremost asset class that we have to keep it in mind. See, cash balance is very important. So when you invest, basically you should have at least 5 to 6 months of cash balance in your hand. For example, if your monthly expense is say 20,000 rupees, then 20,000 into 5. So 1 lakh rupees should be there in your hand. That will help you to basically protect your investment. So cash is the most important asset class which should be there because it is the most liquid. And in this difficult situation, friends, having liquidity in hand is very, very critical and vital. Second, if you talk, is large cap stocks. See, large cap stock play a very important role. Investors is concerned. See, basically, if you see, friends, globally last year, 30 to 35% stock markets had corrected. Even Sensex came down from 42,000 to 25,600 as foreign institutional investors had sold shares worth 61,000 crore in March 2020. The reason was that Corona was spreading, but when this had come, that was the best time to basically buy the take how that happened. Then in January, set an all-time high of 273 as FIIs had invested 12,000 crore rupees. In February, again FIIs 10,000 crore. Then in the month of March, as pandemics across the world, FIIs became debtors and started selling 61,000 crore rupees of shares in 20 trading sessions. So just imagine, friends, that in one single month, they sold shares more than what was sold during the whole year during global financial crisis of 2008. This month witnessed highest ever selling done by FIIs. Then, friends, in the month of March 2020, the Sensex crashed from 42,000 to 25,600. This was the month when there were global lockdowns. So global, all stock markets also corrected. But had invested 1 lakh rupee, just we take a simple example, 1 lakh rupee during March 2020, today it is more than 2.5 lakhs. The simple example, in March 2020, Reliance Industries was available at 900 rupees. Today it is at 2,400. Infosys at Infosys was available at 650. Today it is at 1,700. And basically HDFC Bank at 800 and today it is at 1,500. So drastically markets have gone up. Then in the month April, when because we were able to implement lockdown well, FIIs basically reduced their selling to only 1,800 crores because they appreciated the fact that a country like India was able to implement lockdown in a more successful way even than the global counterparts. And from May onwards, FIIs became net buyers only. In May, they bought shares to the tune of 14,500 crore. In June, they bought shares worth 20,000 crore. And in July, they bought shares worth 7,500 crore. So basically, the year 2020 turned out to be the year in which more than 1.68 lakh crore rupees of shares were bought by FIIs. And this really helped them to grow like anything. From March to June, if you see, Sensex gave a return of 30% as it sharply bounced back. Friends, always remember that in stock market, the best opportunity to invest is during the worst times when the markets crash, because markets then always rebound, and when they rebound, your returns are magnified like anything. Friends, every month if you buy certain good quality stocks like Reliance, HDFC Bank, Infosys, Wipro, TCS from BSE, and when markets improve, you can always sell them and make really good profit. So that is a very good asset class to create wealth over a period of time. Funds. See, those who don't have sufficient amount of time, knowledge, or capital, that means for investment in stock market, you need three things: time, knowledge, and capital. Here, if you are short of any of them, then mutual fund SIP is the best option primarily to go with. In mutual fund SIP, one can do an 8,000, right now, 8,000 crore rupees monthly SIP are coming into stock market through the mutual fund route, friends. So mutual fund is something very, very important asset class where a young investor, a common man is putting his money. Here, the benefit is that a student start invest with basically 500 rupees per month also. If one can do SIP then three things in three types of mutual funds, then it is the best option. Large cap diversified stocks, index fund, and sector fund. If you are able to do mutual fund SIP in these three, then over a period of time, you will achieve very good amount of wealth, and that wealth helps you to create yourself financially independent. So that is something you have to, friends, keep it in mind. The fourth vital asset class for wealth creation, friends, is yellow metal, what we call it as gold. Friends, 2007, the gold prices were at 9,000 rupees per 10 grams. During 2008 global financial crisis, the prices reached 33,000 rupees per 10 grams. Gold always is considered as a safe haven. Remember, friends, it is the most liquid asset after cash. Here, one thing very important, friends, that gold has inverse relationship with three things: stock market, macroeconomic data, and US economy. So basically, if you see, today, if there is a problem in either of them, gold prices will go up like anything. So that is the reason, friends, that during COVID-19 also, when the world economy was in a mess, when there was global lockdown, gold prices went up. This slide basically shows the behavior of gold. See, when stock market crashes, gold prices will rise. When IMF or World Bank says that the world economy is weak, gold prices will go up. And when US data is weak, gold prices will rise. In short, any bad news in the world economy is a good news for gold, and any good news in the world economy is a bad news for gold. So gold will always move in an inverse relationship, friends. That is something very critical, very important. If you take an example of gold, then Indian households has 25,000 tons of gold, friends. We are one of the biggest importers of gold, and gold is the second largest item in India's balance of payment after crude oil. So gold and crude oil are the two major things which affects our balance of payment. In 2015, friends, the price of gold was at 25,000 rupees per 10 grams. Now here, one thing I would like to highlight, that in 2008, when there was global financial crisis, the price of gold was at 33,000. But from 2010 onwards, when world economy improved, things started becoming normal, price of gold reduced to 25,000 rupees per 10 grams. It was only during 2015 Chinese crisis that the price from 25,000 rupees per 10 grams went to 29,000 rupees per 10 grams. So price drastically went up. If you feel this particular point, friends, that is gold investment productive? The answer is clear-cut no, that gold investment is not productive. The reason is that if you put your money in equities or fixed deposits, that money circulates. But if you invest in gold, typically money gets blocked. That is why a lot of economists call gold as a dead investment also. If you see last 100 years return of gold, it is only 6%. If you compare return of gold with BSE SENSEX, that is from 1979, then BSE SENSEX gave a return of 16.5%. Gold gave a return of 9 to 10%. So equities outperformed gold in the long term. Then how much gold one can invest in? See, at least 10 to 15% exposure you should have in gold. 10 to 15% exposure you should definitely have in gold right now. But here, friends, instead of investing in physical gold, it is more viable to invest through gold ETF, gold exchange traded fund, whereby you can buy those units directly in your demat account. So gold ETF plays a very critical and an important role when it comes to investment. Here, the benefit is you can buy units every week, every month, whenever you have money, you are comfortable, and that helps you to average out your cost also. Another option is to buy sovereign gold bonds. See, sovereign gold bonds are basically something whereby you can invest in gold bonds, but the problem is that there is a lock-in period of 5 years. And after 5 years, when you redeem, the redemption happens at the current price. So if the price is less after 5 years, then it creates a problem. Friends, property class to 2020. Markets have two issues. One is huge oversupply and one is unrealistic pricing. So basically what happens is that if you try to buy huge oversupplies, they are unrealistic pricing. So because of this issue, the property market is slightly subdued. You should not be also to use it, consume it. You should buy invest angle, two things. One, huge oversupply. The oversupply is so high, friends, that if you basically buy something, it is difficult to resell a old property. You will not be able to do that. And unrealistic pricing. So these two things will always create a problem for you. Another important aspect is that even commercial properties will have bad times as work from home has become a reality. Today, friends, work from home is a vital aspect and companies are going with hybrid model. So there also one needs to be careful that when you buy a property, that it should be for living purpose, not for investment objective. Insurance, yes. Insurance has become a very important asset class, especially after COVID-19, friends, because during COVID-19, lot of bread earners died and the family members had to face financial difficulty. Today, friends, insurance is no longer considered only as a tax-saving instrument, but a vital component in your overall portfolio management. Here, two things are very vital. One is a term plan, one is a mediclaim. Term plan plays a very critical role. In case of a term plan, if the head of the family dies, the family gets huge amount of money. In case of mediclaim, your hard-earned money is protected. So these two things again play a very critical and a vital role. Remember, friends, today insurance is something which you need to always have in your head, especially in the name of the bread earner. Fixed deposits, yes, though traditional but very important type of an asset allocation, because fixed deposits helps you to create good amount of wealth over a period of time. Correct. Fixed deposit is something which is you have to be this thing. What we can say, safety of capital is the core aspect. So you can break FD and you can immediately get your funds back. So that is why FD, though traditional in nature, should always be there as a part of your investment portfolio. Provident Fund. Provident Fund is the most safest instrument as it is totally tax-free. So that is why Provident Fund is something you should always keep it in mind. It is totally exempted from taxation, though it has a lock-in period of 15 years, yet a very vital component to go with. The conclusion would be, friends, that always remember that asset allocation will always differ from person to person. No two person can have similar kind of asset allocation, as each individual are different in terms of the risk and return criteria. So one thing is clear, friends, one should have a proper asset allocation for vital wealth creation. So with this, friends, I complete my part of presentation. And now we can go for question answer session. So please feel absolutely free to ask me any question which comes to your mind.
Yes, sir. One question is, what about allocating assets by sectors? What if we are allocating the assets by sectors?
By sectors, ma'am. See, basically, you can also allocate by sectors. Then in that case, ma'am, you can see one can basically try to invest in sectoral funds which are a part of mutual fund. For example, see today IT sector, pharmaceutical sector are very important. Without pharma, we cannot survive. So there is a fund called as, example I am taking, DSP Healthcare Fund. So one can invest in that. See today, whatever work we are doing, whatever little work we are able to do, that is only and only because of information technology during these COVID-19 times. So you can go with Tata Digital Fund, correct? Then another important thing is, another important aspect, the third aspect could be that you can always try to go with this particular thing also, SBI Banking Sector Fund, because banking sector is something which will always contribute in the economic prosperity of the country. So ma'am, when it comes to sectoral allocation, the best option is you should go with a sector-oriented mutual fund. That is safe also, and in the long term, you can really create good amount of wealth also.
Thank
Yes.
you, sir.
Sir, my
Anand,
question to you is that, sir, could you
Yes,
throw
yes,
some
please.
light on the buyback of the shares? Because recently Tata has a,
Yes, yes, sure. TCS. TCS has announced a buyback of 18,000 crore rupees at the price of 4,500 rupees per share. See, sir, typically what happens is buyback happens in two conditions. One, when the company management feels that there is a risk of hostile takeover, so in order to increase the stake of the management, they go for buyback. Or second is the company feels that my shares are undervalued, and if the company is cash rich, company has enough amount of cash on hand, then it can go and it will do its buyback. Buyback generally sends a strong signal in the market, and it is the positive side because in either case it shows management is confident of the long-term growth, and that is why it is spending the money to increase its own stake in the company. So it is normally a positive sign.
Sir, if you
Yes.
see the Tata's last 5-6 years record, every 3 years he's going for buyback of the shares.
Yeah, sir, the reason is, see, the TCS, if you see the entire, basically what I can say that the IT pack of India, the biggest benefit with these companies is they are zero debt companies. So basically they don't have any financial charge. Plus their profitability is absolutely marvelous. So when they have so much of cash, they normally feel like rewarding the shareholders. And whenever they have done buyback, it is always more then basically what is the current market. So if I give you a very simple example, that today you buy TCS at, say, for example, 3,800, you hold it and then you offer it for 4,500, then also you are making a riskless profit. And in any case, sir, I would always suggest, and to normally faculties, I suggest this, that not more, but at least 10% of your gross salary every month, you buy these quality stocks. TCS, Infosys, then Reliance, SDFC, but do not sell them. Every month, buy small quantity, 1 share, 2 share, and then basically hold it for long duration. Trust me, sir, you will really make very good amount of wealth. If I just want to highlight one simple example, in 1993, had one invested 9,000 rupees in Infosys IPO, and by chance he forgot that he has invested that amount. Friends, today that amount is 4 crore rupees. It is no joke. You can Google it out because 8 times company gave bonus share, 8 times. So you can imagine the kind of wealth equity creates, but yes, it creates in the long term.
Sir, one last question from my side. Sir, could
Yes,
you
yes, please.
say, because students are using smartphones, they are buying at around 10,000 or 15,000, and every 3 years or 4 years they are changing. Could you advise to the faculties, children also how to invest in the
Yes, sir,
shares?
definitely.
Only in
Sir, yes, yes, sir. Basically, see, as far as students are concerned, not only faculty children, but any student who is getting some pocket money, the best way to make him disciplined is compulsorily make him do a mutual fund SIP. Mutual fund SIP, which starts with 500 rupees a month. Correct. So if you are giving him more money, then you can make him do 2 SIPs, 500 each. So this will inculcate a discipline of investment. Plus, when he invests, he will automatically get interest and he will start reading things. Sir, if you want to be successful in capital market, one of the key aspects is reading. Without reading, one cannot achieve success.
True. One more question, sir. The entire portfolio management you have explained as the
Yes.
asset allocation in 8 priorities. So is it so that HNI client only go for this bifurcation, high net worth individual, or even a small investor?
No. Ma'am, a small investor rather is more required to do asset allocation, ma'am. See, in case of high net worth individual, ma'am, high net worth means he already has lot of capital. So even to be very frank, if he incurs losses, he is not that bothered. But for our people like us who are normally salaried class, it is even more important. And to be very frank, ma'am, there is a lot of misconception that people feel that stock market or asset allocation or wealth management, these are the words, or financial planning, these are things for rich class. No, it is the reverse. Actually, it is more required from a middle class person or from a person with a normal financial background. Because unless you do systematic investments, you can never become rich. Trust me, ma'am, it is not about amount, it is about discipline. Every month, if you invest in a disciplined way, see, if you ask me to put the whole lecture in a nutshell, see, the day you start earning, you should do two things without fail. One is the recurring FD and one is a mutual fund SIP. Trust me, this will create one hand safety capital, on other hand wealth will be created, and third most important, insurance you have to immediately in the name of the brand.
Okay. And one more question is there.
Yes.
Throw us some light on sovereign bonds, which you said not to invest in physical gold,
Sure.
go for ETF or sovereign bonds.
Yes, see, ma'am, basically what happens is, see, sovereign gold bonds are bonds only which invest in gold. But the problem in that instrument is that there is a lock-in period of 5 years. And at the end of 5 years, whatever is the current price of gold, you get your money back on that price. So we take a simple example. See, right now gold is at 47,000 rupees, correct? You invested 5 lakh rupees in sovereign gold bonds. Now, for 5 years, 2027, your money will get in. Now, always remember that in case of gold, if the world economy is doing well, gold prices tend to come down. They come down. They will not go up. Gold goes up only when there is a problem. Gold comes down when things are good. After 5 years, if the world economy is in a position, you may find gold below 40,000. When you reach below 47, you may get 30. So that's with sovereign gold bonds. That is why, to be very frank, that product is not that popular. On the other hand, gold ETF is a very good instrument because in gold ETF you can buy minimum 1 unit and it is listed on BSE. In 1 unit is right now 42 rupees. So even if you buy units, you are paying 4,200 rupees. So every month, every week, whenever you surplus cash, you can buy them. The moment you accumulate 10,000 units, it is 1 kg of gold you have accumulated. So that becomes a more easy option to accumulate gold over time. Yes, ma'am, correct?
Yes, ma'am. Sir, true, very true. And
Yes,
as you already said, there is an inverse relation what the market happens and vis-a-vis gold.
Yes.
That's
gold.
true.
Yes, exactly, ma'am. Exactly.
And you have quoted
Always
that
remember,
examples also in 2008 and 2009.
yes.
How a drastic change happens.
Exactly. And even in COVID-19, if you see, before COVID-19 started, the price of gold was 40,000 rupees per 10 grams. During COVID-19, it went to 50,000, then to 57,000 rupees. Now, with date, I will just highlight one thing. On 12th August 2020, when the pandemic was in full swing, Russia was the first country to say that we have come out with a vaccine. And the moment Russia announced that, gold prices crashed from 57,000 to 50,000 in one single day. And today you can see from 57,000 all-time high, it is at 47,000. The reason is world over vaccination has taken place. Corona is relatively under control, relatively. So always remember, when things become normal at the global level, gold prices come down. Gold always has an inverse relationship.
Thank you so much, sir. You have cleared all the doubts. And you rightly said we should have the 3 things while we are investing: time, knowledge, and capital. If we are not having that, at least we can go for SIP, that is mutual fund. Yes.
You go with the mutual fund. Yes, exactly.
Over to you, Shah, sir.
Sir, happy to say that the doubts related to investment, insurance, asset allocation, and yesterday Indian economy is clear. The questions raised by these faculty members are also been clear. It was a very nice session that we really, the concepts related to the securities market, the overview of the securities market is been principal, sir, Dr. J.C. Pushwani, IQC coordinator, Khushbu Pushwani ma'am, and all the faculty members and from the students, I am declaring the workshop, 3-day workshop is over. Thank you from my side.